Welcome to Trading Nation. I'm Brian Sullivan. We're joined now by Torsten Slok. He is Chief International Economist at Deutsche Bank. Torsten, good to see you again. Listen, the big story with the Federal Reserve in the short term is interest rate increases, but perhaps the bigger story overall is the slow deleveraging of the Fed balance sheet, something that's never been tried and certainly never been seen before. What do you think? What asset classes do you think are going to be helped and hurt by the great unwind?
Yeah, this is an extremely important question for investors. I mean, the logic with expanding the Fed balance sheet, the logic with doing QE by the Fed was to lower interest rates and force investors into risky assets, into credit, and most importantly, eventually into the stock market. So a very important reason why the stock market has gone up so much is probably that investors were forced away from bonds that were yielding low interest rates. So now, doing the reverse, the logic must be that, well, if interest rates now are slowly going up, if we are reversing the balance sheet and it's shrinking, well, you would also then risk that those investors who were hunting yield in the stock market, who were hunting yield in credit, are at risk of saying, hey, wait a minute, why am I buying these risky assets? Why am I buying stocks? Why am I buying credit? If I can get interest rates that are risk-free, government bond interest rates that are higher than they were before. So if the ebb and flow was to move into risky assets, the risk now is, of course, that you could see a reverse effect where stocks could hurt as a result of the Fed running down the balance sheet.
But Torsten, won't that take some time? Because it's not as if I'm making 4% on a very safe stock, right? Maybe a utility or a telecom, an AT&T, I'm just throwing the name out there, and bonds are yielding 2.3%. It's going to take a while to get rates to the point where I'm willing to accept almost no growth for that yield, is it not? It's not an overnight thing.
Absolutely, and that's why the Fed continues to use the words gradual, cautious, predictable, watch paint dry. All these words are used to make sure that this happens in a very slow and gradual fashion, exactly so that you don't get that disruption. And most importantly, the Fed would also argue that the reason why we're doing this is because fundamentals in the background are getting better. And as interest rates start to go up, it may be the rundown of the balance sheet has some risks associated with it. But as interest rates start to go up, that should also be helping stocks, and that should in particular be helping bank stocks, because they are very highly correlated with what expectations are to what interest rates will do. And that has been very pronounced basically since the Fed started hiking rates in December of 2015, that the bank stock sector has been highly moving together with what's happening to Fed expectations. So as the Fed fundamentals for the economy does get better and better, that should also still bode relatively well for earnings and, generally speaking, of course, for the broader economy. So the net effect is still, in our view, that we will see equities perform to the upside as the Fed goes through this exit. But the major risk that we need to watch is this issue of running down the balance sheet. Will it just be like watching paint dry, as the Fed has been saying?
Yeah, but so let's say that you're right and stocks are hurt. I would imagine it would be the sort of the, quote, bond proxies, the utilities perhaps of the world. But banks should be helped, according to you, in a good way.
Absolutely, because remember, interest rates very low is not very helpful for the banking sector. And also, of course, remember also that as the economic data gets better, last week we got the employment report showed an unemployment rate of 4.2%. We are starting to show very early signs of wages going up. We're seeing the ISM for manufacturing, the ISM for non-manufacturing do well. So the broader set of economic indicators is indeed supporting the broader equity market, and is indeed supporting that earnings should continue to look relatively decent as we look ahead over the coming quarters.
Torsten Slok, Chief International Economist, Deutsche Bank. Torsten, always a pleasure to get your views. Thanks again for joining us on Trading Nation.
Thanks for having me, Brian.
Folks, thank you as always for tuning in.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.